Wanted to make a really quick video and talk about common stock, as well as preferred stock, and how to write that in a journal entry. Like, there's several things, like, a lot of it's gonna be, like, centered around different types of, like, financial, um, actions. Like, certain things, like, um, how, like, things operate, and then what it is like pretty much like how you would record those, and like under like what kind of things those would be recorded um, by. Like, for example, like, let's start with something like a cash dividend would be like a contra account essentially. So like if it's a contra account, at the end of the year it should be it should be um, zeroed out pretty much is like the whole point of like the end of the accounting cycle. But then that might actually only be in like the income statement at the end of the year. Like, these companies create these income statements, these financial documents, like following like the accounting standard by GAAP. Essentially, is what accounting is really all about. But let's just go through this real quick. There's some errors in here, but like, so like for example, like on October 15th, this company pretty much, if you take a look, it looks like they debited 22,000 from the common stock account. So like, what that means is that common stock went up, right? Is that right? Yeah. Well, because the thing is, like, cash would be credited because they bought common stock. But the thing is, like, there's common stock at par. Um, so it's like how much the stock is worth, um, and then like what the market rate is. So then, like, if it was paid, like if there was like a additional paid in capital, pretty much common stock, like the market rate was like different than like the par level. So like there's like additional paid in capital, or paid in capital in excess paid in capital, par. So then, like, they purchased like that much stock if it was on par, but like because it was a market rate, they purchased from the market. And then if this stock is purchased from the market and like returned back to the company's holdings, that's considered to be treasury stock now. Um, so like treasury stock would be stock that was distributed or issued, outstanding stock that has been repurchased and now is considered to be treasury stock, very much. And this treasury stock was purchased at a certain amount, at market rate. Okay? So you gotta have to remember, like, at what was this purchased? At what market rate? And then, so like, what happened next is that in November 1st, if you guys read this journal entry, right, you just have to read this journal entry like on um, for November 1st, you know, they declared a dividend on preferred stock. So they declared this dividend, cash dividend, which is a contra account. Um, this contra account, this contra asset account, pretty much is like this temporary account that holds like is like store of value. Another example of a contra account is like um, depreciation account, like depreciation expense is another example of contra account. These accounts just exist to um, store like the number for like something that's like an actual like asset or expense or liability. Like for example, anything related to payables. So like because there's going to be a cash dividend payable, is the reason why there's a cash dividend account, pretty much. So like they declared this dividend on this preferred stock, and that amount is of 140,000. So then, like, where does this money come out of? It is going to come out of cash dividend payable. But the thing is, at the end of the year, like when these accounts have to be zeroed, pretty much like you would take that out of retained earnings, pretty much. So, um, next they've also um, declared cash dividend on common stock as well. Okay. So like how it works is like they first declare it at a certain date, they record it on a certain date, and then they issue it. Okay. So like they decided to declare it November 1st, record it December 5th, and then they decided to issue it, as in they decided to pay it on December 21st. Okay. But there was also this one entry for treasury stock, pretty much December 15th. Um, I suppose they decided to sell some of the treasury stock. So like treasury stock is like stock that they purchased from the market. The company bought their own stock on the market. Um, but then so like they issued it out, and then like it was out there, it was outstanding, but then they decided to repurchase that and put it into this thing that's called treasury stock, their holdings, pretty much. The thing about this treasury stock is that it was purchased at market price, so it's not going to be on par of like what a par value is, like the value of the stock that it's supposed to be at within the market. Has it at a different price, pretty much. So then like they sold this treasury stock. So they sold treasury stock and they received 3,850,000 in cash. So like you record the cash as a debit to like increase the assets, because cash is an asset. So you debit that, and then the treasury stock decreases. You credit the treasury stock 3 million. Treasury stock was sold. So like that was based off of the market rate, and then like if there is like a certain amount that they made, like as in like additional paid in capital in excess of par. So like this is like um, you know pretty much what it is like it's saying like um, more than what it was. I don't know if that's supposed to be income, actually, now I think about it. But December 21st, which we'll see next, is like payment date on preferred stock. So now what happened is like there was that declaration of the dividend on November 1st, the record date of the stock on December 5th, December 21st payment date of the stock, right? So like you'll have like this thing called a cash dividend distributable, and then a cash dividend distribution. So like it's like, oh, this is like this distributable, and then the distribution is gonna be that. So like this, I'm not sure if it's correct, but it's like something like this. Essentially, like I don't know if they're like both contra accounts or like one of them's contra account, or I don't know, but and I don't even know he's supposed to like actually supposed to like write this in the journal entry, like the retained earnings. This might be in like the income statement. Um, but I suppose this would close those accounts, like the dividend account. It would zero out that cash dividend account, and you would be like, where did this money come from? To create this cash dividend, it came from retained earnings, pretty much. and then you'll be like, where's the retained earnings? But anyway, so like June 1st, all right, you declare the cash dividend. They declared this cash dividend on common stock at 5% per share. So like if they don't give out like a certain amount of money per share, then if and it's saying it's like 5% per share, what that just means is that they are going to be pretty much like giving out like 5 shares per 100 shares. So like instead of like it's not saying like, oh, 5% of like the par value or 5% of the market value. It's actually 5%, as in like 5% of 100 shares. And it was kind of confusing, but it's like it's saying like if you have 100 shares, you get 5 extra shares. So that's actually how this dividend's going to be paid out. Is actually you get more shares based off of how many shares you have. It's kind of confusing, but and then like where did this money come from? It comes from retained earnings, pretty much. So retained earnings uh, is like equity account, owner's equity account. So then, well, the thing about retained earnings, like the thing about equity accounts, is that